Okay, good afternoon, everyone. Thank you for joining our first C-Suite Connect webinar series this year, where we managed to get AIMS APAC REIT to join us today. So we have the CEO Russell as well as the CFO Julie here with us. All right. Just to give a bit of context, today we have both the Malaysia and Singapore retail clients with us. So we previously, I think early last week, we actually sent out some reports to let you guys know about the company, AIMS APAC REIT, so that you can actually read up a bit on the company, the background, in terms of where the focus is, so that you guys can have a sense of what we are talking about. So today the focus will be a lot on the third quarter financial results. Right. I'll leave the questions to later on during the Q&A sessions where you guys can actually just jump in and ask the management directly rather than hearing it from me. All right. Russell, you want to go through it first? So that
Sounds good.
Yeah.
Great. Okay. Thanks for the introduction, Billy, and welcome everyone to our 9 months year to date or third quarter business update. Just mind me in terms of the camera. It's not currently sort of showing any lighting, so looking a bit darker than usual. Okay. Look, we might just start with our key highlights for the 9 months year to date. As I think through, over the past 3 months, over the past 3 quarters, we've undertaken quite a number of both asset enhancements, as well as capital management initiatives, to really sort of drive that steady quarter-on-quarter performance and ultimately a steady year-on-year performance. And so it's certainly been a busy first 9 months, and everything that we've been sort of pursuing has led to the current results that we're achieving today. But really, for the financial highlights, for the first 9 months, our revenue did increase by over 1% on a year-on-year basis. Net property income also grew by over 4%. Now, this is really underpinned by same-store revenue performance. We've been sort of driving leasing, fairly actively. It's really our bread and butter. We've also saw the incremental revenue income come in from the Framework acquisition, and that was towards the end of Q3. We also saw the commencement of one of our leases at 7 Clementi. This is one of our asset enhancement projects, and that lease also sort of came in towards the end of Q3. But importantly, we've also seen some good sort of cost savings at a property level. We were able to achieve quite substantial savings from our energy contracts. We're able to sort of secure very favorable rates for the next 2 or 3 years. Subsequently, our portfolio occupancy also increased quarter-on-quarter from 93% back up to 95%, and we recorded a 9 months average rental reversion of around 8%. So again, very sort of steady performance. Correspondingly, distributions and DPU also rose by over 3% and 2.5% respectively. Now, on the capital management front, I'll let Julie sort of cover that a bit later. Suffice to say, the metrics have been held fairly stable, again, on a quarter-on-quarter basis, with gearing sort of inching up to about 36.6% post-completion of our asset enhancement works, which we have budgeted for. Okay. Next slide. Now, financial performance really just carries on from the earlier slide. The overall DPU growth that we've achieved to 2.5% on a year-on-year basis was really sort of supported by steady income growth across the portfolio, and also importantly by lower property expenses arising from the savings in brown energy costs following the procurement of that contract towards the end of Q2. Okay. Might pass you over to Julie to run through capital management.
Hi everyone. Just in front of you, maybe I'll just quickly run through the distribution timetable. Unit holders are expected to receive the distribution on 26th of March. We go ex dividend on 13th of February. Okay. Moving on to capital management. I'll probably just quickly run through the key balance sheet items and the key financial indicators. Total asset about 2.4 billion, increase from quarter-on-quarter, mainly due to the completion of Framework building that we completed in November 2025. Correspondingly, liabilities has also increased due to the completion of the acquisition. Net asset value per unit stable at $23. Leverage ratio 36.6, following the completion of the 2 AEIs that Russell mentioned earlier, and also Framework acquisition. Debt funding costs on an average basis have tapered down to about 4.1% from the high of 4.4%. Average debt maturity is about 2.3 years. Interest cover, including all the hybrid distribution, which in our case, perpetuals, it's 2.6 times. Excluding that, it's about 4.7 times. Fixed debt ratio as of 31st December, about 65%. Okay. Moving on into this slide. In terms of capital management priorities for this year, as you can see on the table on the chart on the left, we have no debt maturing in this FY, our FY ending 31st March. The earliest debt that require refinancing will be November 2026. That is on the bar, the purple bar that you see. Now, having said that, we are already in active discussion with current and existing lenders to look into the refinancing plan of this debt tranche. Not only we are looking into solely on this debt tranche, we are also looking into where are the areas that we do have more expensive debt and look into restaggering the whole debt maturity holistically in the upcoming FY. The current financial flexibility stands strong at about 124 million. Post-quarter end, we have also raised a perpetual security at about 4.1%. If that perpetual security, in the use of proceed of that perpetual security is to be used for CAPEX, AEI acquisitions, among others, it can also be used for the refinancing of the upcoming perpetuals that we have due in September, carrying a rate of 5.375. Now, pure math based on the refinancing will give us a saving of 1.9 million on a per annum basis. Now, in terms of Forex risk management, we do have 3 assets from Australia that give us distribution in AUD to Singapore on a quarterly basis. We do correspondingly hedge this distribution in AUD to Sing dollar via forward currency contracts. As of 31st December, we are about 74% hedged. Back to you, Russell, on portfolio highlights.
Great, thanks, Julie. So moving on to the portfolio, I think what's really driven our performance over the past few quarters, and in fact over the past 5 years or so, has been having a fairly well diversified portfolio by country, by asset types, by sectors, by lease structures, having a good mix of long-term leases with fixed step-ups, also with shorter duration leases that allow us to capture that rental reversion as leases mark to market and expire. So that diversification has really sort of then led to that balanced growth over that period of time. Importantly, as you can see, logistics and warehouse make up just under half of the portfolio income. That's really the one of the key drivers of same-store performance, given the sustained demand that we're having, particularly for our warehouse assets over the past few years post-COVID. Okay. On the leasing front, again, we've had a very active year. We've done 1.7 million square feet of leasing to date. That's almost 20% of our portfolio by net lettable area. So that's substantial. We typically churn around that level of leases and covering 20% of the portfolio. And that's very notable in the sense of we've been able to maintain that occupancy between a 93 to 98% level, whilst being able to drive that rental reversion of about 8% for the 9 months year to date. But if we look across on a quarter-on-quarter basis, our sort of warehouse properties and our high tech in particular, were able to achieve double-digit rental reversions. Whereas our business parks was relatively flat to slightly negative on a quarter-on-quarter basis. And industrial has been tracking close to about the mid-single-digit levels, which is pretty consistent to where we thought at the start of the year. If you look across some of the notable leases signed during this quarter, we did renew Illumina, one of our top 10 tenants. So that was a great result, we achieve a 11% reversion on that renewal. We also brought in Hanwha, a pretty large Korean conglomerate, who took up one of the anchor occupiers space at our 1A International Business Park in Singapore. And that's notable because that's also increased our property occupancy from what was around 60% over the last 2 or 3 years to hitting close to over 90% once the actual lease commencement. Okay. If we look across the balance of FY2026, we've got just under 4% left. The team is in active discussions, and we hope to sort of finalize most of the leases over the coming 1 or 2 weeks. But looking towards FY2027, as you can see, about 3/4 of the rental expiries will come from the warehouse segment. Again, we have continued to see reasonably healthy and sustained demand from both our 3PL customers as well as from end users, business occupiers, and industrialists. Top 10 tenants, really, there's been no change over the past few quarters. As you can see, most of our large tenants have fairly long WALEs, other than our 3PL tenants that are typically churning every 3 to 5 years. But importantly, if you look across the actual industries of which our customers and tenants occupy in, they mostly operate in defensive and resilient industries. Logistics, food and consumer staples, data centers, telecommunications, life science, and healthcare. So this is fairly resilient, recession-proof industries, and it really sort of underpin the stable performance that we've achieved over the past few quarters. Occupancy, again, we're back up to over 95%. At one point, we were tracking around at 93% levels, and that was mainly due to the vacancy that we had at 7 Clementi due to the asset enhancement works that was ongoing, as well as some transitory movements between some of our larger 3PL customers. But I think it's important to note also that the increase in occupancy also came from 1A International Business Park, our only business park asset in Singapore, which sort of increased from about 60% in the past few years to over 90%. And looking forward, if we look at the market outlook, it's certainly still fairly uncertain. There is a lot of questions around, what's Trump going to do tomorrow? How does that affect tariffs? How does it affect trade? But if we look beyond that, in terms of the structure fundamentals, we feel confident in both the Singapore and Australian market. We do continue to see fairly healthy investments and also growth across the pharmaceutical, healthcare, and life science industries. And we've also seen quite good sustained demand, particularly across the technology and AI-led demand, which has seen an increase in semiconductor investments as well as electronics components. And we've seen that across our own portfolio. Quite a number of our master tenants are in that advanced manufacturing industry, where they are essentially manufacturing components that fit part of an overall ecosystem. And we've also seen recently, there was some recent news. I think Micron, they're building a new fab facility. I think they're looking to invest over $24 billion US in Woodlands, and that's going to lead to a downstream supply chain demand across the ecosystem for both industrial space and warehouse space. We've also seen quite a number of the pharmaceuticals and life science companies such as AstraZeneca, Pfizer, invest over $1 to $2 billion in new facilities in Tuas, again, driving the downstream supply chain requirements across the ecosystem. So we are still seeing at this moment in time reasonably healthy demand for industrial space. A bit that I think customers are typically looking for modern and new facilities rather than the older style properties. Across in Australia, the markets again been fairly stable, despite the sort of higher cash rate that has happened. We are still seeing quite exponential growth in terms of infrastructure investments, in terms of population growth. That's led to really continued demand for warehouse space and business space, not only across the industrial sector, but also residential and other sectors as well. So that bodes well for us. We are spending a lot more time looking at opportunities in that market, and we are seeing some potentially good opportunities, particularly those that have large land sites near key infrastructure nodes that provide underlying improvements in land value. Okay, and look, just to really conclude, we believe we are well positioned for continued growth. We've built a very sustainable business and platform. Our team has had a good execution track record across leasing in terms of keeping occupancy high, driving rental reversions, capital management in terms of taking opportunistic issuance if the market windows are evident, and also early refinancing, and also undertaking value-add strategies across both asset enhancement works and in the future, potentially, looking at development opportunities. And so if you look at really our key value drivers across the platform, we've got a strong portfolio that's well diversified, good assets, good tenant covenants across diversified industries. We've got a good balance sheet, financial resilience. We have headroom for future growth. And in terms of growth pathways, we believe we've got both organic growth opportunities that we're working through, as well as, more importantly, this year with lower interest rates, hopefully more acquisitions that will support the continued growth of the platform. So that really concludes the presentation. Might hand it back over to Billy.
Thank you, Russell and Julie. I think this is good. So you have a lot more time for questions. Anyway, while waiting for the audience to put in the questions, we do have some questions that were sent in earlier that we've received. I think first of all, it's probably in terms of the DPU growth. I guess the question is, I think you guys have seen an increase of 1.1%, right? So how sustainable is this growth going forward, especially with current macro conditions? And could you share what are some of the main contributors to the growth, like whether it's coming from rental reversions, whether it's asset enhancements, acquisition, or whichever? Yeah.
Yeah. Maybe I'll start, and Julie can chime in on some of the details as well. I believe you're referring to, is it DPU 2.5%? That's the context. So if I look at DPU, that's obviously one of the key metrics that we always sort of focus on. Now that's really a combination of both the portfolio performance. As we mentioned earlier, that's the core heart of the portfolio in terms of rental growth. The fact that we've achieved 8% rental reversion whilst keeping occupancy reasonably high, 95%, is again a pretty good result for us. Because as you know, when you're churning through portfolio leases, there's always that balance between trying to drive higher rent whilst keeping occupancy at a reasonably high level. So being able to achieve both the growth and occupancy at a good level has been key to sustaining the overall revenue growth. We've tried to complement that with the asset enhancement works. So when we're looking at the portfolio, we don't sort of undertake asset enhancements every year. We try to sort of stage it to give that organic incremental improvements. And then also thinking about acquisitions. So the fact that we did an acquisition last year with Framework Building, you'll see the benefit come through the portfolio later in the year when you get the full year contribution, because that only came in towards the end of November last year. So it's really a combination of factors. And then you couple that with operating cost savings through lower utility costs. That sort of helps you achieve your top line net property income growth of 4%. And then obviously, below the line in terms of capital management, trying to be proactive and enter into early refinancing, hedges, as well as issuances of perpetual securities, which we've managed to do progressively. And every time we've done so, that rate has come down. So I think the ultimate goal for us is to drive overall cost of capital lower. But really, in order to do that, you also need to have very stable track record of growth, so that both your banks and the bondholders are comfortable that we are sort of delivering a very stable and safe performance that is predictable. Hopefully that answers the question in a roundabout way. Julie, is there anything else to add? Okay.
I think Russell said it all. Nothing else to add.
Okay. And just wondering, in terms of the average cost of especially on your interest, I guess one of the reasons was the interest rate in Singapore was cut quite a fair bit last year. And we're not sure what's going to happen this year, but how do you see that going forward in terms of the cost management portion?
We continue to try to drive the average debt funding cost down. But I will have to say with caution, because as mentioned earlier, RBA has just hiked, right, for the cash rate from 3 another 25 basis points. So that pressure will probably still remain. In terms of sink front, yes, you're right. We do see overnight SORA coming down to about 1% handle lately. But in terms of the longer yield curve, which is 4 years, 5-year trajectory, that remains a bit higher compared to last quarter, mainly due to the risk premium that market has priced in. Having said that, on a balanced basis, we still do think that as of this juncture, we can see some savings coming through in the next financial year. That also is dependent on the refinancing effort, how much we can achieve on the holistically upon refinancing, what is the rate we can achieve. But I wouldn't want to stop there. That is on the financing, borrowing side, debt side. Perpetual side, because our capital structure, we do have some perpetual. Debt savings can have also come through. Last year, August 2025, we refinanced the perpetuals of 125 million, carrying a rate of 5.65, with perpetuals carrying a rate of 4.7%. 1.2 million savings has come through on a per annum basis. Post quarter and earlier part of this year, just a few weeks ago, we are also looking into how to opportunistically take opportunity on any windows that we can see. We raised 150 million at 4.1%, assuming that's being used to refinance the upcoming perps carrying a distribution of 5.4, close to 5.4%. That will also crystallize the saving of 1.9 million on a per annum basis. So we want to look into all these capital management actions holistically, whether it's borrowing line, whether it's cost of capital, or even the perpetuals.
Okay. And I mean, now that we've talked about that, let's focus on the next thing, which is probably growth. I think data center is a part of your under high tech. Am I correct? Sorry, I suppose I'm right.
That's true. Yeah, actually, our
Wondering
data
how much is
center.
it driven by that, and do you see that?
Sure. We've got one
I'm
data
just wondering,
center.
how do you see the growth?
Sure. Growth more broadly, or on the data center side? You're talking about growth on the
On
portfolio.
the data center side. And
Okay. Maybe I'll just highlight. We have one data center in the portfolio. It's actually covered under industrial. So industrial, the segment itself is quite wide varied because it includes advanced manufacturing, it includes food distribution, it includes data center. High tech for us is our only life science facility in Woodlands. And that's a combination of production as well as some office innovation type facility. To be honest, sometimes that definition can be blurred because at the end of the day, whether it's high tech or advanced manufacturing, they are in very similar sort of domains. But our data center is in fact a very small portion of our overall portfolio. We've got one asset in Tai Seng. Now, Tai Seng is a highly sought after data center precinct because if you look at the underground infrastructure, that's where all the actual cable structures come in and converge. So think about Tai Seng as the intersection with all the traffic lights and all the various cables. So from a data center point of view, it's actually a very strategic location. But as you know, Singapore has a moratorium. They do have applications that they go out to market. They've had one, and I think they're having the second RFP currently going on. Each time they will allocate anywhere from 60 up to 100 megawatts, which is enough for maybe 3 or 4 data centers. So I think Singapore's got maybe 1 gigawatt, 1.2 gigawatt, which is not that big relative to our neighbor in Malaysia, which is like almost 7 to 8 in the pipeline. What we are looking to do is to find ways to grow that exposure. Now, how do we do that? We will look at potentially finding sites that we can pair up with an operator, but whether it's in Singapore or Australia. Now, I think Singapore, because it's essentially fairly scarce land and most of the power, JDC is now pushing towards Jurong Island rather than the main island because of the connectivity considerations and the cost to build those connections. So I think that's probably where the direction is going to go. For us in Australia, we have 2 business park assets in Macquarie Park and Norwest Business Park. Now, if you look at the size, Macquarie is our Optus Centre in Macquarie. That's about 7 hectares, 70,000 square meters. Woolworths is about 90,000 square meters site. And so we are exploring whether we can apply for power to both sites. It's still very early days. Normally, the application process would take anywhere from 3 to 5 years, because the infrastructure and the grid is not built to cater for so many data centers. So we are undertaking that process. It's again, from our point of view, it's just optionality. At the end of the day, we are getting income from the two master tenants, and the income is growing every year. But in the meantime, it's just nice to know, can we get power? If we can get power, okay, maybe we can pivot part of the site. It doesn't have to be the whole site, to some data center components. So we are exploring these ideas. It's still pretty early days. I would say between the two, Macquarie and Norwest, Macquarie Park in Sydney is very similar to Tai Seng in the sense that it's also one of the sought after top 3 to 4 sought after data center locations, given the underground infrastructure that is there as well. So there's quite a number of DCs already in Macquarie Park, and it's certainly something that we are thinking about. But we would like to do it organically through our own development rather than buying stabilized data centers.
Okay. I would like to continue on that conversation, but there's a question from the audience, so just gonna jump into that first. I think from Ricky, it's asking about a drop in the NTA per share from 2024 to 2025. Is there any particular reason for it? And what's the expectation for 2026?
I think the drop in NTA is mainly due to we have some revaluation loss last year. We do our revaluation every 31st of March. So 31st December, you don't see any revaluation done on the portfolio as yet. So 31st March 2025, there was a slight, about 1.5% revaluation drop due to cap rate expansion from the Australian property and also some depreciation in AUD last 31st March 2025. So between 31st March and now, NTA has been fairly stable at $1.23. Expectation going forward, maybe Russell, you can chime in as well. I think in terms of AUD, I would have expected AUD probably rock bottom already. Now that RBA has hiked, I would think AUD currency is probably going to be slightly stronger compared to last year. Maybe I'll pass that back to Russell to comment on cap rate for properties as well.
Yeah. So I think Australian properties, they're typically, from a long-term lease point of view, how the valuers will capture the value is they just look at the contracted rents and they do either a DCF or income cap. And the income cap method, they will also adopt a cap rate based on the most recent transactions. And so sometimes you do see, particularly for valuations in Australia, that they move a lot more up and down. Compared to Singapore. Singapore, as you know, there's just because you have JTC administering land sales, and they typically want end users to be there. So the valuations typically are a lot more, I would say, more stable generally. The only way to get the valuation up is from what we've done, doing asset enhancements and increasing the income. But for Australia, look, we're not too concerned for a few reasons. One, we are contracted on a long-term lease, so we're getting good income. But the other part, which I mentioned earlier, is just given the size of the land that the properties are situated on, we believe there's underlying land value and optionality that's not captured there. And so if you think about even something like Woolworths headquarters, it's 44,000 square meter building, but you have potential to build up to almost 270,000 square meters. That's almost 6 times your GFA, based on some of the similar developments that have occurred in the location. And so if for the Woolworths headquarters, what you can't see is you just see a building, but actually it sits on about half the site. The other half of the site is an open air car park. And so you can actually build up a multi-story car park within the existing structure. So the underlying foundations actually allow you to build another 4th block and also additional car park space, which may then allow us to take back some of that land. And if we can build either a new building to service the Woolworths main campus, or you build it as a separate standalone service residence, or you build it as a small data center, as an example, then you can create a lot of value from those opportunities. So when we think about Australia, as you can see, they all sit on pretty large land plots. We think there's a future redevelopment optionality that's not captured in the value. And you know, I think it's up to us to really sort of drive those opportunities when they arise. And in addition to the two Australian properties, also bought right up top, you can see behind this, it's basically a waterfront behind. On the right is a bulky retail complex. And on the right of that is a regional shopping mall managed by Stockland. And then all around it is residential. On the left, you've got a gym. You've got some of the other I think Domino's Pizza and a few other places. This is just an old what's it old? It's an industrial building nestled in between what could arguably be a nice mixed-use development in the future because you've got the water, you've got the retail amenity, at your doorstep. So again, this is not captured in the value. You only, that the valuers will just take the contracted lease cash flows into account. So valuations may go up, may also go down. So I think that's just the nature of the market cycle. But I think if you look on a longer term basis, I think the focus should really be on the income side of things, and then hopefully waiting for us to capture that value add opportunities.
Okay, thanks, Russell. I think there's another question on the company's gearing, and also asking whether there's room for further M&A.
Okay, so the gearing is at a fairly comfortable level, 36%. At the moment now, we've completed framework building last year. We are looking for more opportunities in both Singapore and Australia. Sorry, Julie, you want to go back to the acquisition slide, the track record? And so if you think about Australia, the things that we're looking at are assets that have large land plots, anywhere from 3 to 4 hectares as a minimum, up to 10 hectares. So we like big land plots with secure cash flow, typically near some main infrastructure or catalysts, right? That over time can create high underlying land value. So those are the type of things that we're looking at. And in terms of Singapore is a little bit different. There's less big land plots available, but as you can see, we bought framework building. It was a 4 to 5 year WALE, but a very high 8% yield. And I think it's rare to find any industrial building that is right next to the Paya Lebar MRT, in fact, and also minutes drive from the PIE, selling for 8%. So we were able to secure this off market. It was a very long negotiation process. We managed to agree and negotiate with the anchor tenant to prepay the rent for 5 years. So you got zero credit risk. There is, and that rental is growing every year. You got the incumbent tenants like Parkway Labs that are also in the building, looking to take up more space in the future. And the other thing that you can't see in the building is it's got a lot of power. And the power is very important because when you're negotiating and dealing with advanced manufacturing or life science, power definitely is a key focus. And this site, in fact, used to be an old manufacturing site. So the location is good, the cash flow is good, and also from what we see, future AEI positioning. Why? Because the current anchor tenant framework, they distribute building materials, building products. And so you're not fully maximizing, in our view, some of the bones of the building. If we're able to find an advanced manufacturing customer or even if Parkway Labs take up more space, they will pay a higher rent. And not only will they pay a higher rent, sometimes when we look at the overall structure of the leases, you're able to charge also on some of the brown energy costs, and there's also a small spread on that. So we look at those type of things in Singapore. There's not many of those type of opportunities with high yield and future value add. The last property we bought also was 7 Bullen, and that was a ramp up property. We like that because again, in a very good location in Jurong Innovation Precinct, and also very good specs. And we always think that we can always lease it up, either on a floor by floor or to a whole building user. So again, Singapore is probably more the cash. We're looking for cash flow. We're looking for stable income. Australia, we're looking more at large land sites with income, but future optionality to hopefully redevelop or enhance the site.
Okay. So Russell, just wondering, I mean, they focus mainly a lot on Singapore and Australia, right? Is there any plans to look at other markets? Like, say, example, we talk about just now data center, right? You did mention that Malaysia has a lot more of that. So is that something that you guys would consider?
So I think we are very much asset led, and so if we think the opportunity presents itself where it gives us a what we call a good risk return, we will consider it. As I mentioned, buying a ready-made data center is typically, in our view, quite expensive. The yields are typically quite compressed, and it very much depends on the duration and length of the lease tenor. Because a data center also has a lot of technology and chips and infrastructure that's always changing. I think our view is we would like to participate through a development phase rather than buying a ready-made opportunity. So I think we are open. It's not something that we are actively pursuing. We have done some evaluation of the market. But again, I think our immediate focus certainly will be Australia and Singapore.
Okay. And just wondering within your subsegments like your logistics and warehouse, business park, industrial or high tech, which will be your key growth driver that you think? Because I'm sure you would have seen the demand that's coming from whether it's in data centers or in advanced manufacturing, which probably gain a bit more traction with the ASEAN Plus manufacturing plants by a lot of the MNCs and all that. So could you give us a bit of color on that front?
Look, our portfolio, the bulk of the leases, as you can see, three-quarters coming up next year, will come from that warehouse segment. Uh, and interestingly, we have experienced close to 18%, 24%, 20% last year, and currently this year tracking close to 8%. So it's managed to really sustain itself. And so when we look in the market and we kind of think about where the supply is coming from, where the demand is coming from, uh, there has been no shortages of inquiries. The volume has not been as much as in 2024 to 2025, but certainly there's still a healthy set of demand, and that's also reflected in the occupancy that we've seen across the segment. So definitely logistics and well, from our point of view, the leasing side will continue to do well. In terms of our recent asset enhancements in our master lease, the main occupiers that were able to take on those spaces at the higher rents were the advanced manufacturing, those involved with the electrical components. We even had one of our master tenants have a whole section of rare earth materials. And so this is certainly an area that we are seeing that is still reasonably strong and growing, right? Particularly with the continuation of AI and also all the tech space, perhaps even EVs and robotics in the future.
Okay, thanks. I think we have another question from the audience. It's asking about the currency. I think the strength of the Aussie dollar against the Sing dollar recently. Is that something that investors should be concerned? Maybe you share about some of how your hedging and stuff, so that just give a bit of color how you manage that risk.
So for the distribution from Australia to Singapore, we receive on a quarterly basis, and therefore we also hedge ahead of time on a quarterly basis as well. Now, Aussie dollar is actually more of a beta currency as a risk currency. We don't take unnecessary risk, so therefore we usually hedge around 60 to 70 or even 80% depending on the market sentiment. Now, with AUD strengthening, obviously, I do see more positive sides, mainly because you see strengthening of net asset value. The asset value from Australia will come out stronger. Secondly, the net distribution from Australia will also be higher because we do have some unhedged portion, and that will come out at a spot rate, assuming the AUD is stronger. On the liability side, we do have loans in AUD. Obviously, that will also increase slightly, but I do not expect that to have a material impact in terms of our gearing that will be affected by the stronger currency.
Okay. I just want to have one last one. I think is basically on your rental reversion. Could you provide us some guidance on how you see the rental reversion going forward, maybe in the next 12 to 18 months? Just give us a sense of.
Yes.
Yeah.
So I think when I started the year, I was sort of guiding towards that mid-single to high single-digit levels um, across the board. I think we're kind of generally sort of tracking to that level. Of course, if you think about the various subsegments, most of the warehouse rents have continued to be reasonably strong. What I think is when you've had a few good years of rental reversions, a good sort of level in terms of moderation, would typically want to sort of track close to your mid-single digit levels. So I do still see that's good reversions coming through. As I mentioned earlier, we are still seeing quite significant capital investment by global MNCs across particularly semiconductors. That's a very big industry for the Singapore industrial ecosystem, coupled with life sciences and healthcare, medical related. That's also a pretty strong an important segment of the industrial economy as well. So I think those based on those underlying demand factors that will lead to downstream demand. If I look at supply, 2025 supply was also, I think, double or three times our average annual supply, which is around about 1 million square feet. And so the market was able to absorb most of that supply. From where we see in 2026 and 2027, I think that supply is going to be a bit more muted. There's not going to be a lot more things from what we can see coming off. And the next sort of big supply that may come through with some of the projects that we are aware of will come in 2028 onwards. So, I'm quite positive. Again, I think a good level and a good sort of sustainable, healthy level is about that mid-single digit levels. And that's mostly coming from our warehouse segment.
Oh, mostly coming from the warehouse segment.
That's right. So if you go to next slide, Julie, on lease expiries, you see that the dark purple bar in FY27.
Oh, okay. In terms of the rental reversion for the different business segment, is there an average that you can share with us? Like how much is it for logistic and how much is it for business park? Do you have that?
Yes. So, I mean, you can see here on average, on a
Oh,
quarter-on-quarter basis. So
so rough.
logistics, it started with
So
7% and then went to 17 and 12. So on average for the 9 months, it's been about 10% or
so
10.5%.
high tech is the one that is with the higher rental reversion. Is that the because
That's
it's
right. That's right. That was a Alumina.
okay. So I'm guessing that will be the focus of the company going forward in a way when you look at M&A opportunities and all that.
That's right. That's right. I mean, when we bought Framework Building, Framework is considered under industrial. And so, I think you do have about a 4 to 5 year well. So you won't have any sort of leasing sort of work to do for that asset. But the way that we structured that deal is that the anchor lease rental rate is about 20 to 50 cents lower than the in-place rent from the other tenants in the building. And so over time, we may look to take up back some of the space, do an asset enhancement, and hopefully, mark to market and push up the rents. But that's another 4 to 5 years time.
Okay. I actually got a question from a friend who just texted me. I was asking about the risk in terms of for you guys. How do you see what are some of the biggest risks for you guys in terms of whether it's macro, is it the geopolitical uncertainties that we are seeing, or is it the interest rate? Which one would you be keeping an eye on closely? Yeah.
I think all the above. I mean, if you look at the macro environment, you've got the Trump factor that can change
Yeah.
at any time, good and bad. All the supply chain dislocation actually will benefit Singapore in the medium term, but in the short term there might be that volatility. And if you look at some of the growth coming from all the AI segments, obviously we're all watching that to see how sustainable those segments are. But I think in terms of electronic components and semicon, it's not just AI, it's also going to be things like EV cars and things like future robotics. There's a few other elements that will also require these electronic components. But also, so just watching that whole ecosystem, how it's evolving. And also, I think the last thing is really on interest rates. That has a bearing. But if you've seen how we manage our capital management, we try to take a proactive approach both on refinancing as well as issuances of perpetual securities, right? So we try to capture that window. And the important thing that you should also just for your viewers is to see how we've been able to reduce the PERT pricing over time to drive down the overall cost of capital. So some of these things that we've done, it doesn't show up straight away because it will come through at a later point when you do the redemption of and repay down the existing perpetuals. So I think whatever we end up doing this year, you will get some benefit over the course of the year, but the actual value is actually will follow the following year as well. Just like this year, we've seen the benefit come through from the AEIs and some of the other capital management works that Julie's been heavily involved in.
Okay, thank you, Russell. Maybe just leave us with one final key takeaway if there's any that you think investors should take from this webinar.
Sure. Look, I always think about how do we fare, compared to our peers. I would say our sort of key drivers of value. One is our portfolio strength. As I mentioned, we are quite well diversified, but not only through diversification, but also in terms of the industry that we operate in. So most of our tenants are in that defensive industries. And most of our top 10, these are very strong financial covenants. So this underpins the distribution that is paid to investors. The second one is financial resilience. We've got a pretty strong and resilient balance sheet. We tried to keep gearing throughout the years around the early to mid 30s, sometimes going up to late 30s. But generally, we've been quite conservative on that front. And also taking early action on capital management initiatives, not waiting for too close to the actual expiry, taking a bit more proactive view of the market and just balancing the overall structure. And I think the important thing is in terms of future growth, because when you look at some of the things that we've done, we're not done, right? We've done the 2 asset enhancements. There are other feasibilities that we're working through at the moment. That also includes upgrading work, that includes development work, but we need to stage it, right, to get again that year-on-year growth. This year will be a big year, hopefully, on acquisitions. Our cost of capital on both the equity and debt has tightened. That should allow us to hopefully make some good accretive acquisitions. So that would be a major focus for us. And I guess you try to complement that not only with the acquisition and upgrading work, but things like sustainability, solar panels, and things like cost efficiencies as well is going to be a key driver of growth for us.
Okay, thank you, Russell. All right, for those of you who do not know, AIM Separately is part of the SG Next 50 within the SG Next 50 index as well. So we will be uploading the webinar on YouTube for those who missed the webinar, and we'll be sharing a key takeaways via email. If you have any questions, feel free to just drop us an email and let us know. All right, thank you guys. Thank you everyone. Bye.
Thank you, Billy. Thanks all.
Bye.